Welcome to this webcast presentation of Etteplan's Q3 results for 2020. My name is Juha Näkki, I'm the President and CEO. And at the end of the presentation, we will have a Q&A session where you will be able to ask questions from myself, and also our CFO, Per-Anders Godin, will be available for answering any questions that you may have. If we look at the contents of the presentation first, so highlights of Q3, financial development in Q3, we'll look a little bit on our targets, how we are doing against those, and then followed by the Q&A session. But first, if we go to the highlights of quarter three, so first of all, of course, the market condition due to the pandemic was not good. The pandemic had an impact on our customers' business and of course, naturally, an impact on our business as well. So basically, we had to continue, or we were forced to continue the sort of defensive mode that we had to take, or into which we had to move in Q2, and we continued with the defensive approach throughout the third quarter. This mode of operation, however, produced good results. We were able to keep a very high profitability for the third quarter, despite the declining revenue, which was very positive. So the measures we have taken to protect our profitability have really worked. We were also very pleased with development in China. The market in China has been fairly good. It turned better already in the second quarter. And in the third quarter, it has been solid and the demand has been good. So we were able to increase the number of hours sold to the Chinese market by 12.1%, which was a good result. We also were able to, due to the fact that we have been generating good, healthy profit during the year, our cash flow has been very good. So we were able to also move forward with our investments for the future. And we made an acquisition in the Netherlands, acquired a company, Tegema, which is focusing mainly on production-related solutions, and this is a good new addition to the group. On the negative side, of course, revenue dropped due to the weak market conditions that we had in the third quarter, minus 10.3% quarter to quarter, and year on year we also fell to negative minus 1.1%. If we then look a little bit more closer to the acquisition, so Tegema in the Netherlands is focusing on production solutions, mainly to the high-tech industry. It deploys about 100 engineers, and the revenues last year were approximately 11 million. Two locations of operations, Eindhoven and Arnhem in the Netherlands. And this was completed in September and in our numbers in the books from 1st of September onwards. So one month for the third quarter. But this is a little bit different to what we have done before. Tegema focuses on production solutions where we have been active as well. But Tegema is also delivering production cells to the customers. And this is an interesting opportunity for Etteplan. As we see that the Industry 4.0 development is continuing, production solutions are becoming more and more complex, they are becoming more and more connected, and so on. So integrators for production cells into the existing production lines are needed, and we have the right kind of competence to actually take this position. So it's an interesting area, an expansion in our competence base, and gives us a much more focused effort towards production solutions, and we will continue to work with that throughout the group. If we then look at the operating environment a little bit more in detail, of course the demand has weakened due to the pandemic, and the uncertainty in the market has increased also now that the second wave of the pandemic is affecting the markets where we are operating. It was clearly visible also in this quarter that after the summer vacations, when the second wave was sort of starting, that the uncertainty caused our customers to delay projects and investment startups, and this had a little bit of an impact on our figures as well for the third quarter. Customer-specific differences were again considerable. Some customers are still doing relatively well, whereas others have genuine problems. Also the investment decisions in digitalization seems to be the one that mainly all our customers are either continuing or they are the ones where they will continue to invest the first once they start to go more towards the sort of investment path. If we look a little bit on countries, so Finland, the market weakened clearly in the second quarter and on the third quarter stayed at a quite low level of demand. In Central Europe and Sweden, we could see already in the second quarter a slight turn for the better in demand in the market. And this to some extent continued in the third quarter as well, but of course now with the second wave of the pandemic increasing the uncertainty again, so now it's difficult to say what will happen. But a slight positive tone, I would say, is still there. And China, of course, the market has recovered, and as mentioned earlier, we were able to return to the growth path in China, and then we see that this will continue at least throughout the year. And if we look at the revenue split, then engineering solutions represented 57% of the revenues in the third quarter. For the first 3 quarters of the year. Software and embedded solutions 24% and technical documentation solutions 19%. Revenue by country was Finland 62%, Sweden 22%, China 3%, and Central Europe 13%. And then personnel by country, Finland 59%, Sweden 18%, China 10%, and Central Europe 13%. The changes are of course due to the fact in the headcount, and also the revenue are due to the fact that we have made acquisitions mainly outside Finland in last year, and also now with the Tegema one. Revenue by customer segment, forest, pulp and paper, still the biggest one. General industrial machinery and equipment also 14%. Energy dropping slightly, mining dropping slightly, lifting and hoisting and slight increase, and in the chemical industry, where especially our German acquisition of last year, our EMP, is working, a clear increase, but otherwise no major changes in the customer segments. And in the key figures, revenue came down 10.3%, operating profit EBITA by 20.7%, and EBIT by 24.9% in the quarter. Of course, the comparison quarter did have fairly large positive one-time effects, which are affecting the comparability here. On other figures, earnings per share down by 31.6% and cash flow by 81.9%. But I would say that after a very strong cash flow in the second quarter, this is a sort of more normalized level. For the full year, the revenue is down by 1.1%, EBITA 7.2%, EBIT 11.4%, and earnings per share by 14.8% so far. And if we look at the market outlook, so it remains relatively the same. Of course, the pandemic has now developed more, but still, when we have the pandemic with us, so the uncertainty is clearly there, and the uncertainty will have a negative impact on our business. On the financial guidance, we updated the guidance and clarified our guidance for the operating profit part, EBIT part. So now we expect the revenue to decrease slightly or be at the same year's level, while operating profit, EBIT, will decrease clearly compared to 2019. Basically, revenue is a little bit hard to predict right now because we don't really know how the second wave of the pandemic will be impacting our customers' decisions to start new investments and so on. But I guess we currently think that the revenue development will be similar to Q3, maybe slightly positive. But then on the profit side, when we had Q2, we were uncertain where we could develop with the profit. Now, with the market not turning for the better, we see that the operating profit will drop clearly, but it will not drop significantly due to the fact that we expect to be able to maintain a high profitability level also in the weaker demand going forward. If we then look a little bit more in detail on the impacts of the COVID, so of course our customers' declining demand has a direct impact on us. We can see clearly that our customers' order intakes and order books are at the lower level than they were a year before. However, there are some customers where the order intakes are improving against Q2 this year, so that is a little bit encouraging, of course. But when this situation is what it is, it stays the same, so we will need to continue the defensive approach. And so far, the measures that we have taken to adapt our organization and the cost-saving programs that we have had during the year, we have had good profitability during the year. We have had temporary layoffs, unfortunately, during the year, and at the end of September, a total of 286 employees were temporarily laid off, either part-time or full-time in Finland and in Sweden and in Germany. And of course, also we have had to cut down on the spend, and especially the external spend. So our strategy execution has been slower this year than what we would have wanted and what we anticipated in the beginning of the year. But we are, due to the good profitability, we are able to transform back to the more investment and growth-driven mode as soon as the market recovers for the better. And we will be able to do that very rapidly. Currently, of course, we are still working remotely, and over 85% of our personnel is working from different kind of remote locations, and we have been very successful with this operating mode as well. If we then look at a little bit more detail on the financial development for the quarter, so revenue was 55.2 million, so a drop of 10.3%, and of course due to the weaker market condition. Organic growth or organic decline was minus 13.3%, so even higher. And of course we did see a decline of 14% from our key account customers, which had an impact to this. Due to the market situation, we have also been a little bit more cautious with our recruitment, so the number of personnel has come down in this market situation. But we are looking to improve on that as soon as the market develops for the better. And as said earlier, also the summer vacation period and the start of the second wave of the pandemic had a little bit of an impact on the project starts and therefore also the revenue development. If we look at the operating profit EBITA, so we were able to hold a high profitability for the third quarter, which was very, very good for a third quarter. So the EBITA percentage was 9.5%. If we compare it to last year's 10.7%, so there were quite different non-recurring items. So this year we had a slightly negative figure, whereas last year we had 0.8 million positive, which was due to an earnout revaluation. So if you look at the comparative numbers, we are fairly close to last year, which is fairly good, I would say, in this kind of market. And if we look at the EBIT, so the EBIT percent was 7.7%. EBIT was at 4.3 million euros, and the same one-time effects, of course, having an impact on this one. Amortizations related to acquisitions were 0.9 million for the quarter and 2.8 million for the full year so far. If we then look a little bit more detailed on the different service areas, so in engineering solutions, the revenue was 31 million and dropped by 12.1%. And of course here the market demand has had a big impact on our revenue development. And of course the summer vacation effect that I mentioned earlier was affecting this service area as well. We have had to, of course, do our best in the sales to find new opportunities, and we have done whatever we can in the market. And doing that, we have been able to remain or have still a very high operating efficiency, and that has enabled a still strong operating profit percent. In the software and embedded solutions side, this is the service area where we have seen that investments have continued to some extent. There are still customers where the investments are down, and this has had an impact on our revenues. But here we have clearly been able to improve our operating efficiency and therefore maintain a very high profit level. And the profit level here was affected also by one customer write-down due to a customer bankruptcy. So without that, it could have been even better. But of course, here the pandemic having an impact, and also the same comment on the summer vacation and the second wave of the pandemic impacted demand there. And in technical documentation solutions, also a solid performance. The revenue was 10.2 million, dropping the least, so minus 4.5%, and also the profitability was strong. So a good performance, good operating efficiency here in this service area as well, but of course affected by the market and the same summer vacation comment as well. On the software sales for HyperSTE, this type of investments are clearly down from our customers. Decisions are clearly not taken, so the level of software sales has been low throughout the year and continued still in the third quarter. Earnings per share, 13 cents for the third quarter and 46 cents so far for the full year. And cash flow operating cash flow at 0.2 million euros in the third quarter, which is sort of normalized level. We had exceptionally strong cash flow in Q2 due to the fact that our costs were coming down faster than the revenues. Now the situation is quite normal, and when we will start to grow again, then the costs will increase faster than the cash flow. So then we are on the average, we will be back on the normal levels, and we believe that the cash flow will reflect our operating performance over a certain cycle. Return on capital employed dropping still 12.6%, and here of course having an impact from the IFRS 16 decision, so our interest-bearing liabilities are higher for that reason, and also we have some more loans which are affecting this figure. On the personnel, we had at the end of the period 3,291 employees, so a drop of 4.3%. Employees outside Finland were at 1,340, so a slight drop there as well. But we believe that now with the market turning in China, we will be able to improve on these numbers. On the income statement, nothing major, but the clear difference compared to last year is in the other operating expenses. So our cost-saving programs this year have had a clear impact on our performance on the cost side. So we have been able to react to the changing market conditions very well. And on the balance sheet, of course, Tegema has been brought into the balance sheet. Those slight changes in the goodwill and assets and other things, but no major changes in the balance sheet either. And then if we still look on the targets, so revenue target is 500 million by 24, and of course now with the COVID year, we will be relatively on the same as last year or drop slightly. On rolling figures, we are at 261 million, so you could say that 1 year we have had to sort of cut from our target setting, but this just means that we will need to work harder in the coming years to reach our targets. Revenue outside Finland is slightly growing, so 38% now for the first 9 months. The share of managed services at 60% and operating profit at 9.5 so far. So this is where we are, and now it's time for the Q&A session. So I would please warmly welcome any questions that you may have. So please, operator.
Thank you. Just a reminder, if you do wish to ask a question, please press 01 on your telephone keypad. If you do wish to withdraw your question, you can do so by pressing 02 on your telephone keypad. There will be a brief pause while questions are being registered. Okay, so our first question comes from the line of Ossi Vasania from Nordea. Please go ahead, your line is open.
Great, thanks. This is Ossi Vasania from Nordea Bank. Well, I have three questions to start with, and then, if I may, a couple of more also after the first round. So, I mean, when looking at the kind of the temporary layoffs currently, I mean, has there been any changes in that in October, or are we going to have a kind of same kind of kind of capacity in the fourth quarter than already seen in the third quarter? And then, when looking at the customer segments, secondly, I mean, what is the most weakest customer segment for you when looking at the kind of third quarter or even fourth quarter, and would it probably be even the mining sector, if I may give a kind of some guesses there? And then the last one from the first round is the guidance. I mean, seems to be that you added this clearly down wording for your guidance. So, is the reading instructions for this guidance that the EBIT is down slightly more than 10% on year-on-year basis? This is the first three ones. Thanks.
Okay, I'll try to remember them. So basically, what was the first one? We start with the.
Yeah, I mean the layoffs and the situation in October, and what's the capacity in fourth quarter against the third quarter?
Yeah, sorry, Pasi. I mean, the temporary layoff situation is it's relatively the same as it was at the end of Q2. Of course, it's changing from customer to customer, so it's not the same people that are temporarily laid off. But unfortunately, our customers are having different kind of situation, and now with the market uncertainty increasing, so we are you know, uncertain of how the situation will develop. It's hard to say now with the second wave. You see different kind of measures taken by different countries. It's hard to say how this will impact the industries and how this may impact the saving programs from our customers. But we believe that it will be relatively the same unless there is a clear change in the market, either for the better or for the worse. And it's hard to predict how it goes. Unfortunately, I'm not able to give a more detailed answer on that one. Then the second question was about the customer segments. So I guess that the automotive segment was, which is not that big for us, but that segment has been clearly down, and we have had a weaker demand there. Also, we could see that in the mining segment, the situation has been slightly down. There are some okay projects, and there is investment into new products and so on with some of our customers. So more and more R&D related work, but the level of project type of work is of course down in this segment. Overall, I would say segments are down, some slightly more than others, if that's the right kind of interpretation. And then the third one on the guidance. So yes, we did clarify. We have not given the exact percentages on the wording, but of course clearly is less than significantly, which is the sort of most extreme word that we use. Basically, the reason for having, before we said that it will the profitability or EBIT will drop, but we were not specifying how much, due to the fact that if the market had turned better, we could have been fairly close to maybe last year. If the market had gone significantly worse, it could have been worse. But now, as we see that things are around the same as they are, and we expect it to be throughout the year, So then we specified it clearly. So it's not the worst one we have, but it will not be as last year. That's what I can say.
Thanks, I hear you. And then, if I may, a couple of questions still regarding the kind of the capacity and current run rate at the personnel level and capacity. So, would it be even possible that you are actually going to run your business with 15% off from normal level at least next 2 quarters? So, I mean, when looking at the kind of the environment and customers, definitely, I would expect that it's fair assumption that nothing is going to happen to a positive territory or to the positive direction in before the year end. And then practically regarding the kind of the remote work or at home working, if it would happen that something 75-85% of your all workers would actually be at home or remotely working, were there any kind of changes in the offices or premises, or would you able to save kind of rents or other expenses on annual basis, and what would be the amounts in that sense? Thanks.
Yeah, well, first of all, the operating efficiency, we were extremely good in transitioning into this kind of remote working mode. We have not lost any momentum on the operating efficiency due to this, and we expect to be able to manage that also going forward. We have proven in the previous quarters our resilience in our business and in the model, and of course that has some also tough decisions that we have had to make during the years, which is not nice, but with this we have been able to manage, and we expect to have the same kind of operating efficiency and therefore similar profitability levels. Of course, there may be variations, but we expect to be able to continue running at the high efficiency unless something dramatic happens in the market. And then on the remote working mode, so basically you are correct. I mean, if you look at our other operating expenses, so part of the savings there is of course traveling and other stuff related to that, but part is of course savings from the operating expenses, offices and so on. I would not say rents because these are not very short contracts, and right now we don't really know how fast the situation will change and how it will change. But we do see that the remote working mode to some extent is here to stay. We are also continuously working to develop that because in our line of business we have the opportunity to work remotely from wherever. We don't have any production, we only have computers, and as long as you're connected you can do your job at Etteplan. So this is an opportunity that we can offer our employees, and going forward we will of course look at optimizing our premises and optimizing our other ways of working so that we can also generate cost savings in the future. How much, that's too early to tell, but this is something that we are continuously looking at and trying to develop.
Great, thanks. That was all from my side.
Thanks.
Thank you. Our next question comes from the line of Juha from Interim. Please go ahead, your line is open.
Hello gentlemen, this is Juha from Interim. I will start with a question that is probably quite similar to the last one, and I will just form it like this, that how sustainable is your profitability currently? I'm wondering about if there are some special elements that will go away, let's say at the year end or something like that, or is this sustainable level if you don't see any recovery on demand? And I'm talking about the whole year, not the Q2 seasonal effect.
Well, I would say that we have now proven that the model is resilient, and I'm confident that we will be able to maintain high profitability. There are of course certain government supports which are playing a minor role, And perhaps one issue which is the sort of possibility for temporary layoffs in Sweden may have an impact. The law there is changing at the end of November. So after that you will not be able to have these kind of temporary layoffs anymore in Sweden. That may have a small impact, but we have been able to improve our business in Sweden, and also we see that there is a slightly better market recovery in Sweden compared to Finland. So we believe that this will not have a dramatic impact for us going forward, but a slight impact maybe in December onwards. But no other things, and we do expect that we will be able to maintain good profitability.
All right, fair enough. Also about the second wave of pandemic, I'm wondering if you see a clear correlation or negative correlation between the client demand and activity and the case numbers that we are seeing when they are rising and falling.
Yeah, so far not yet actually. So we see that the cases are growing and more restrictions are set by different governments. But so far they have not been set towards the working condition or factories and so on. So the businesses continue to run. It's more restaurants, nightlife, these sorts of things which don't have an impact for us so far. But it's of course really difficult to say what may happen in the future. But somehow we believe that societies will continue to run, businesses will continue to run, and for that reason we don't expect to see a huge drop in demand. But of course this is something where I can be also totally wrong. But this is how we see it right now.
All right, fair enough. Finally, any kind of outline or outlook for the next year would be very useful. So any chance you would give us something to go on regarding year 2021?
Well, it's of course very early to tell, but we do believe that a major turning point for demand, and especially for investments, is the time when a vaccination is coming to the market. So I think that is required for our customers and their customers to actually see the sort of end of this pandemic. And once that is there, then I believe that our customers will start to invest more. So the sooner that happens, the sooner the market recovery will start. How swift that is depends on very many things, but we do believe that somewhere next year this will happen, and you probably know the medical industry better than I do, so you might be better to predict when this could happen. But we see that as a sort of turning point for investments.
All right, thank you very much. That's all for me.
Thanks.
Thank you. Our next question comes from Erika Salokivi from Evli. Please go ahead with your question. Your line is open.
Yes, good afternoon. This is Erika Salokivi from Evli. Thanks for taking my questions. Both Pasi and Juha already kind of touched upon the subject I was going to ask first, but regarding this profitability, sustainability, but you essentially, when looking at adjusted figures on EBIT, you've kind of actually managed to keep the margins on essentially unchanged levels, but you probably also cut quite a lot of costs. But I was just wondering if the activity were to decline now, how would it mean that the margins would be taking a more substantial hit now, or do you still have kind of room to improve on costs in that aspect?
Well, of course, we have done everything we can to save costs. We have had very limited investment. So naturally, if the market were to decline rapidly, then of course our fixed cost will start to hit us a little bit. So if there is a clear drop in the demand for us, so of course then our margins will be slightly under pressure. We don't have that much more to save, but we don't believe that will happen. But should that happen, then of course also our margins would be slightly under pressure. We will have a few tricks up our sleeve still, and we have now during this quarter we have continued investments to some extent. We also acquired a company and so on, and these kinds of activities. There we might have some savings, but you are right in the sense that if there is more drop in the revenue, so then our fixed costs will hit us a bit harder and the margins will drop. But if it stays on the same level as we now believe for the remaining part of the year, we should be fine with healthy profitability.
Okay. So I was just wondering, maybe just looking back at the post or since the start of the coronavirus, you've probably been doing quite a lot of own estimates and kind of scenarios for what will happen. But has the kind of development so far been in line with your expectations, or has there been kind of any, for instance, now during the second wave, was that kind of already in your plans, or has there been, is it looking worse than you were expecting, or in anything in that aspect?
Well, as I mentioned in the presentation, we did see that in the sort of at the summer vacations when the sort of second wave was a little bit starting. So then we could clearly see that it's quite typical in our business that our customer projects don't start, after the summer vacations that fast. So there is normally a small delay. This time around there was the increasing uncertainty related to the second wave of the pandemic on top of that. So we had a little bit more, let's say, waiting time there, and some projects were cancelled and some were starting late and so on. So that there was a little bit of an impact. But other than that, I would say that it has been going relatively as we have anticipated, and we have been able to take measures to defend our business and our profitability, and we are doing everything we can to find new opportunities. So I would say that so far it's gone as planned, but of course it's hard to tell what will happen. But I don't believe in these kind of massive lockdowns of businesses and these kind of massive restrictions where people are not able to move at all due to the fact that there is already too much debt in the societies around the world. So I don't believe that will happen. May be wrong, as I stated earlier.
Okay. Then just maybe still ask about software and embedded solutions. You commented on it earlier, but kind of looking at the start of the pandemic, it was kind of, or maybe my expectations only, but that area of business would be kind of more resilient given the kind of investment tendencies. But it's still been, sales have declined quite in line with the engineering solutions as well. So could you maybe just comment briefly about what's been like the factors there and what's the outlook?
Yes. Well, there was one certain incident in the first quarter where one of our customers insourced a substantial amount of people, which had an impact on our business, which was very unfortunate, but that is what happened. That had an impact. And then we have seen that some of our customers have taken measures all over the different service areas and all over the different competencies. So there have been some customers that have just cut everything and reduced spending on everything, not specified that we will continue this and not continue that. And that has had an impact on this service area. And we have had to act on it. And of course that has had an impact on our organic development as well. But still, I would say that our operating efficiency has been good and even improving during the year. And this is the area where I do see that our customers will continue to invest in first when they start to invest into their business again more. So I believe that there are significant opportunities there going forward. But it's also a little bit of a surprise for me that also this area has been under cuts from our customers.
Okay, sure. Thank you very much. That's all from me. Have a nice day.
Thanks.
Thank you. Once again, if you do wish to ask a question, please press 01 on your telephone keypad now. Okay, since we don't have any more questions at this time, speakers, please go ahead with your closing comments.
Okay, thank you very much. So basically, this year has been totally different than what we anticipated, of course, due to the pandemic. And as said, we were forced to move into this kind of defensive mode of operation in the second quarter and continue throughout the third quarter as well, and most probably also in the fourth quarter. So the year will turn out to be weaker than we anticipated, and most probably our revenue will decline for the third time during this curve has been made. So that is unfortunate, but still I think that the defensive game that we have played has been extremely strong. The transition into that one has been very swift, and we have been delivering healthy profitability despite the conditions, and we have also been able to invest into our future by acquisitions and also in internal development now in the third quarter. So I believe that after a difficult year, we will be able to during next year when the market recovers a little bit, so we will be able to move forward once again and move back to this kind of profitable growth mode that we have had in the past. Should you have any more questions, feel free to contact us at any time. So myself, our CFO, Per-Anders Godin, and our SVP for Marketing and Communications, Outi Torniainen, will be happy to answer any questions that you may have at any time. Thank you very much for watching and have a nice day.